What's going on, everybody? It's Johnny here from GT Trades, and welcome to the first video of our Options 101 series. So this first video is going to go over just the basic essentials, the basic definitions, and really cover just the top level view of the options world. And of course, from the things that we talk about in the video, you guys can research more in depth if you want to, but we're going to keep this at a top level in this video. And as we progress through the series, we're going to get much more in-depth, and we're going to provide you guys a lot more details into those definitions and everything else about the options world. So in this video, what are we going to do? We're going to go over how to read an option, and mainly that refers to the option chain. We're going to pretty much go over just the basic difference between what a call and a put is. We're going to look at an example of a call and a put options chain. We're going to tell you a little bit about Delta and Theta, because I think that we at GG think that these are the more essential basic things about options that beginners should understand. And then we're going to go over some tips and tools to help you guys pick the right date depending on what type of trader or investor you are, and then give you guys a couple of the options trading keys and give you a sneak peek into the next couple of topics that we'll be talking about in this series. So getting into how to read an option, and when you're looking at options chain, what are the things that you are going to be seeing, or what are the most important things that you really should pay attention to, of course. And guys, keep in mind that these are just basic definitions, and the in-depth things that really are entailed with some of these definitions and concepts here, that will be covered later on, but we just want to give you guys just the basic overview definition of these things. So when you're looking at an options contract or a chain, of course, first you have the ticker, and that refers to the stock that you want to buy the option for. So if I wanted to buy a contract for Apple, I would just type in AAPL, look at their options chain, and so on. When you're looking at the date, this is also referred to as an expiration date, and the expiration date is when the contract can either be deemed in the money and exercised, or if it is out of the money, it'll be considered worthless. And we'll go over the difference between out of the money versus in the money. And that leads straight to the strike price. And the strike price is the price which an option can be exercised if it is in the money, meaning that the underlying is either at, above, or below, depending on if you have a call or a put. And if it's in the money, then you can exercise that. But again, we'll go over the benefits and in-depth things about exercising an option later on in the series. When it comes to premium, this is simply the cost of the contract. So when you're talking to other traders and investors, they might ask you what the premium you got the contract was for. That's simply the cost of the contract. When it comes to implied volatility, or IV, as you'll hear a lot, that's essentially just a short-term prediction of the stock's movement. So a high implied volatility means typically that it will be a higher premium or a higher cost. And one thing to note for IV is that there is a big difference between IV, which is implied volatility, and historical volatility. So, as you're looking at an options chain, and we'll go over this, one IV might be considered normal for one stock, but for another stock that might be considered high or low. So when it comes to a call versus put, this is as simple as you can break it down. When you are looking at a call, or some option that you want to get a call for, that is entailing that you bet the stock is going to go up, whereas a put, that means that you are betting that the stock will go down. And when it comes to trying to differentiate between the two, this is essentially the most basic definition you can provide and remember for yourself. Calls mean up, puts mean down. So for this example of the options chain, I've pulled up Apple's, both call and a put options chain on Robinhood here. I'm going to stick with the beginner platform because, a lot of people here are probably using Robinhood and kind of want to see how this is broken down here. So on the left side, we have the call option chain. So here's my ticker, Apple. Here's my expiration date. And, as you do this on a drop-down menu, you'll see different expiration dates going down here. Here's my strike price here. It's, I have the left column here. You have the premium, also known as the price, on this right side, and then you have the implied volatility here. And this is you'll be able to see this information as you click on each strike price. So the more you open, you can just scroll through and compare each of them. On the right side here, we have the put option chain. So same ticker, same expiration date, Strike prices, as you can see, they're listed in the same manner. But the one thing that you want to pay attention to is, how the premium is trending here. So for this options chain, and we're going to jump back over to the call side. You heard me talk about in the money, out the money, right? So Robinhood does a little nice trick here. Every platform does some way of distinguishing in the money versus out the money. So for the call side, as you are betting that the stock is going to go up, as you can see, the share price here is 128.7. And this line is here because everything below this line, so everything under 128, and you want to look at the whole amount. Everything under this green line here is going to be considered in the money, and the contracts are worth more the further in the money that you get, because as you can see here, the premium is rising as you go down. So 128, 127, the premium gets higher, and what that means is those contracts can be exercised. They have what is called intrinsic value, and as you go up. And anything over 128.7, so 129 is considered out of the money. See how the premium is slowly starting to decrease here because these are out of the money. You want the stock price to move towards the strike price, which is why the calls are betting that you're going to go up. When it comes to the put side, this is the opposite. So as you can see, here's that line I was talking about. Everything above 128, so 129, 130, these are considered in the money on the put side. As you move down towards the lower prices, these are considered out of the money. And for the basic definitions of the call and the put, this is your right to purchase 100 shares of Apple at the certain strike price if you want to buy it. If you are looking to sell or exercise an in the money put, this gives you the right to sell 100 shares at the strike price, depending on when you exercise it and, of course, the premium that you paid for it. So for Delta and Theta, again, as a GG, the Delta and Theta are really the main things that we keep into consideration, and we really actually look at the Delta value when it comes to the option chain, but we're explaining Theta because it's a very important concept for beginner traders to understand. So when you're talking about Delta, the basic general definition of Delta, that represents the change in option premium or cost relative to every dollar the stock actually moves. And when it comes to Theta, the one thing that beginners should remember is that the definition and what they need to remember about Theta is that it represents the change in option premium relative to time. And you'll hear a lot of videos or other people talking about time decay or theta burn. And you want to remember the definition of Theta. So as you get closer to the expiration date, Theta will begin to kick in, and it's more of an exponential curve for the option premium. And just know, for all the beginners, just know that the closer you get to the expiration date, the less your contract will be worth. So that really starts to kick in, I would say, either about a week before the expiration date, anywhere between a week to about a week and a half is when you'll see the premium on your contract slowly kind of start to come off, and it'll be worth less. So if we go back to the options chain, right, you'll read the delta here, and one thing I should have mentioned before is that this premium and the price that you pay, when you're looking at the options chain, you want to multiply this value, the price, the premium, by 100 because theoretically and officially, calls are the right to buy 100 shares, puts are a right to sell 100 shares. So the premium cost, this isn't 86 cents. This is really $86. And that leads me into what I want to say about delta here. So when it comes to reading the delta, 0.31 is not really 31 cents for every dollar the stock moves. So let's say that we're going to buy this 130 contract when this share price is 128.7. Let's say I bought it for 86 cents. If this Apple stock, if this share price goes up a single dollar to 129.7, this contract that I bought will rise in value by 31.31, times 100. So this is actually theoretically $31 if Apple moves up a dollar. So it'll be 86 cents plus 31 cents, which turns out to be $117, I believe. so somewhere in that realm, $117. And that's really what you want to read for Delta. And one thing that you should remember as well is that calls are positive on the Delta, and puts are actually negative on the Delta. So, here, this is actually $68 if this were to go down $1 for Apple. So what are our recommendations when it comes to picking the right date, when it comes to the type of trader you are or the type of investor you are? So when it comes to day trades, we always, recommend contracts expiring the same week, of course, unless it's after 2 p.m. Thursday, because for a day trade, that means you are literally in and out on the same day. However, something that I've personally noticed and a couple of people at GG have noticed when it comes to contracts and day trades is, when it comes after 2 p.m. Thursday, assuming it's a full 5-day trading week, what we've seen is, a lot of those contracts expiring the next day tend to take a theta burn after 2 p.m. on Thursday. So for day trades, we highly recommend that you stick to contracts expiring the same week, unless it's after 2 p.m. Thursday. Then you can probably get a cheaper contract or a better contract for contracts expiring the following week. For swing trades, we always recommend that you take contracts expiring the following week, because swing trades entails that you are holding it overnight. You don't want to have any risk of that theta burn I was talking about. Whether that's you get it on Thursday or Friday, you don't want to experience that risk of theta burn. So for swing trades, get the contracts expiring the following week. That's just our recommendation for it. When it comes to leaps, and if you don't know what leaps are considered long-term contracts that can be anywhere between 3 months all the way up to 3 years if you wanted to. For my personal trading strategy as well as investment strategy, I usually get about at minimum 3 months out. I know some people that get it at least 6 months out, at least a year out. And a lot of this really depends on the stock. If it's a fast mover, it's a slow mover, etc. Things that you need to consider when it comes to everything else: strike price that you're going to buy for the contract, levels. What this really refers to is where it's at in terms of support, resistance. And if you don't know what that is, of course, we will definitely be having videos on that as well. The spreads, and so spreads and open interest and volume are things that I'm going to be covering in just a second. But the spreads are essentially the bid and the ask. When it comes to the market trend, always look at what's going on in the market, because some things might be having a great technical setup. However, if the market is not looking good, what that does is it completely invalidates the setup, because if some big sell-off happens, the stock will likely follow the market trend. Open interest and volume. So this is actually a very key thing that I think beginners should also understand too. So for open interest and volume, we're taking back to the option chain for Apple. So open interest, that refers to the number of contracts that were held from the previous day. So that means there are so when it comes to this specific 130 contract for Apple, this 32.7 thousand open interest means that there are currently 32,700 contracts open from the previous day. And this gets updated every day, so this number might be different the following day. When it comes to volume, this is the number of contracts traded each of the current day. So when you look at volume and open interest, just know that the volume represents the current day's trading quantity, and the open interest refers to the number of contracts that was left open from the previous day. And the key here is that if you're looking at an options chain and you see one specific contract has a much higher open interest than another contract, so the difference between the 130 calls and the 130 puts is the open interest is higher on the put side, or I'm sorry, the call side, much lower on the put side. So typically that might give an indicator to a lot of people are more bullish, or are betting that Apple's going to go up. And that's the key when it comes to volume and open interest. When it comes to the spread, as I mentioned before, here's the bid and here's the ask. So it is always better and less riskier to trade options that have a tighter spread. So as you can see here, the spread between the bid and the ask is 4 cents. That's typically considered okay. Pretty decent. Now let's look at the spreads between the put side for the same 130 contract. 2.95 versus 3.15. That's about that's a 20-cent spread. So, you know, if you market order this, that means that you might get filled anywhere between this. That really depends where there is a seller. But if you do a market order for this spread, you have a 4-cent range that you're probably going to get filled in. So anywhere between 84 cents to 88 cents. And for this spread, anywhere between 2.95 and 3.15. So for a couple of keys that the GG community has for a lot of our members, and you know, the things that we've been finding a lot of efficient, effective trades on. Number one is, of course, you need to plan your trade, and then you need to trade your plan. So really, what does that entail? That entails finding the right entries, finding the right exits, and planning it, and of course, executing on those. So looking at those support, resistance levels, and following that, really risk management. It's simply put as, you know, don't over leverage, don't have so many open positions. You always want to keep the trades that you're in relatively small compared to your trading account. And we also have a risk management video that we'll leave down the link to. But when it comes to risk management, just make sure you don't have too much tied up. Make sure you have only what you're willing to lose in the market, you know, depending on how much that is, and, you know, depending on the market circumstances and everything going on. And I would say the most important thing when it comes to your trading plan and execution is stop losses. So stop losses, you know, what you want to do with those and how you can incorporate that into your trading strategy is having stop losses helps you keep the losses small. But if your stop losses never hit, you know, you might win big. But the most important thing is when you do lose, you want to keep those losses small, because there will be times where you are consecutively losing. And if you keep those small, it won't affect your account too much. Second, we have the do not chase tip. So as you are continuing to trade, as you're continuing to watch the market day in and day out, if you're an active trader or investor, you really want to avoid chasing those big moving stocks. What we recommend is putting them on your watch list, analyzing the price action, or if there's any news or any other fundamental things going on with that company, you know, really analyze it, take time to digest it, and then you can plan a trade after you've put it on your watch list, you've digested news and looked at those levels. Thirdly, we have patience, guys, and as an investor and a trader, your patience will get tested day in and day out, and when you think you have patience, you will get tested and pushed further to the limit. So we can't stress how much patience is important in your trading plan. Let the plays come to you. So you can start out by watching just a couple of tickers and really start to plan your trades for each of those tickers. Let it come to you. Stick to your strategy when it comes to your entries and exits. And then once you enter the trade, stick to it. So if you have a goal of getting 20% on the options contract that you currently enter, the trade that you entered, once you hit 20%, then you can exit, because that's your plan. You know, don't get too greedy, and that's why it's important to stick to your plan. Lastly, but not least, never trade with emotions. You know, when it comes to any of those wins that you see, and if you stick to your plan and you exit at 20%, you check back and that contract is at 80%, sure, you can take a second to be like, oh, damn. But when it comes to being happy with all of the wins, that's what you really need to remember at the end of the day. It was a win, it's green, it's better than losing money. When it comes to the opposite side and you are experiencing consecutive losses, take a couple of minutes, whether that's a couple of minutes to a day to 2 days, to really recollect, analyze what went wrong in the trade, and then go back to the first phase here, or the first key here. Plan your trade, trade your plan. It's going to be tough for people when you take consecutive losses, but the important thing is to remember to just take time, keep the emotions out of it, analyze what went wrong, and then reset. So that's all we have for the first video of our Options 101 series, guys. And, you know, we want you guys to keep in mind that, again, those were just the most top-level basic definitions and tips and tools that we're gonna offer, you know, just to start the series. As we get more in-depth into the series and really start to break things down, you know, here are a couple of things that you can really expect to be covered in the rest of the series. So, you know, when I talked about levels, we're going to go over in depth how to find entries and exits. You know, when it comes to actually trading shares versus options, there are a couple of stocks and things that we look at in GG to help us determine, what we should do when it comes to trading a stock, whether that's the shares or the options. Then we have candlestick strategies, and if you haven't taken a look into the basic candlesticks, we highly recommend that you go ahead, Investopedia or any other big well-known resource to really start getting the hang of noticing candlesticks as you are looking at charts, because candlesticks, a lot of them apply on almost all time frames, because each candlestick tells a story about what was going on with the price action. So really being able to determine and recognize some of those key candlesticks will help you as a trader as well. And then, of course, I think that one important thing is to really give you guys insight into a couple of the trades, or a single trade that we do in GG. So we want to break down whether that's one or two trades, look at the levels that we had, what was appealing to it, and then we might give you guys insight into why we didn't take a specific trade. But again, what was covered in this video is the basic top level stuff. Here's what you can really expect coming out in the next video or two videos. But we hope you guys enjoyed it. If you guys have any questions, go ahead and leave it down in the comment section below. We'll have a link to the GG community in case you guys want to come check it out. But that's all from us, and we'll catch you guys in the next one.